If you've ever looked into investing, then you've probably heard of the mutual fund. They've dominated the investing market for decades. Actually, more like a century now. They're typically pushed by major banks, and the older generation got used to using them to invest because they help you have a more diversified portfolio that's less risky than picking individual stocks, which can be riskier.
I own many mutual funds that outperform the S&P 500. So the average person ought to just buy index funds. Well, I've got a real problem with that.
But the thing is, mutual funds have high fees. The banks push mutual funds because they're able to take a high management fee for actively managing the fund for you, and that's just not necessary anymore. There's now easier, more passive ways to invest that let you keep more of your money for yourself, and the mutual fund just isn't the only option. In today's video, we're going to be breaking down what those other options are, including index funds and ETFs. So let's get into it.
So let's start off with what these three ways of investing all have in common. And listen, it might be super obvious just by hearing the name. So mutual funds, index funds, exchange traded funds. Guess what? They're all funds. But what is a fund? Well, a fund is a basket of different things like stocks, bonds, and currencies, right? And more, but all bundled up in one. Literally, picture a basket with different investments already in there. So instead of you having to go in to choose those investments individually and by yourself, basically all you have to do is pick up one of these baskets and you're good to go. At least that part of the process, at least the choosing part, is done for you. Now, not only can funds be diversified by having different types of investments, so stocks versus bonds, but you can also buy funds that are focused in on different industries, companies, countries. So for example, you could go out and you could buy a fund where the only investments in that fund have to do with technology. Or you could buy another fund where it's just US companies versus ones that cover global markets. Or you could even buy one that just has large companies. So for example, the 500 largest companies in the US. Sometimes there's these other super customized options too. Like I know a popular one that I'm sure you guys have heard of is the ARK Innovation Fund. So this one strictly invests in companies that are involved in innovation. And then I guess there's also like the Vice Fund, right? So this one would invest in companies that are involved in gambling, alcohol, tobacco, and I'm sure you guys can picture the rest. Anyways, we all get it now, right? A fund is a basket of different types of investments that you can buy all together and you get to choose which one you want.
Now, typically when people are talking about mutual funds, they're specifically focused on actively managed mutual funds. Now, this is when a group of investors all pull their money together and buy a mutual fund basket that a fund manager, which is a real person, they're the ones selecting which stocks and other investments should go in and out of that fund over time. Now, this is exactly why it's called an actively managed fund. And it's because there's a real person or group of people that are analyzing which investments are best to go into this fund with the aim of outperforming or beating the market. Now, they're the ones who are deciding what to buy and what to sell and at what time to get those best results. A super quick history lesson on the mutual fund is that they were actually first introduced as a way for the average person to be able to have diversified investment options that were still going to be lower cost than having to make all those decisions by yourself or having to buy every stock or investment that you could get in a basket individually. Now, basically, it was a way for the middle class to start investing too, and not just the super rich. Now, I keep highlighting the word diversification because it's really important for reducing your risk. Let's use an example to talk about this. So let's say right now that you had all your money invested into stocks of Apple. So you only had any of your money into Apple shares. Now, obviously that would sound kind of good right now, considering that the money has grown a ton in their value and their wealth over the last several years and decade now. But at the same time, if the company crashed tomorrow, then that means all your money is gone and your portfolio is done. Basically, having a mix of different stocks or different investment options, maybe spread out over different industries or different global markets, that's reducing your risk. But even with all that being said, there is a problem with mutual funds, like I said before, and specifically with these actively managed mutual funds. Now, there's a higher fee that you have to pay in order to buy them because there's someone involved who you're paying to do their job and actively run the fund for you. Now, typically these fees are about 1% to 2%. If 2% is sounding pretty low to you, let's go through an example that puts it into some better context because it's definitely not very low. So a strong average return that you might see in the market is about 8%. Let's use that as our benchmark. Let's say that you invested $2,000 per month for 30 years and got that average 8% annual return. That means 30 years from now, you'd have $2.8 million of your return. That's great. But let's say you had to pay 2% of that 8% in fees. Now you're kind of seeing that that's a quarter of your total return that you're paying in fees, and you'd be paying almost $1 million in those fees. That means your $2.8 million would go down to $1.9 million, and that's all you'd actually get to keep. Now, you might be thinking that if all you get to keep is still $1.9 million, that sounds great. But if you can keep more of your money and more of your return, and there's options to do that, why wouldn't you go that route? The other really important thing for me to mention here is that people at first were willing to pay these higher fees because they of course thought that these fund managers were beating the market for them. So as long as they were getting better results, then it meant that it might be worth the fees. But this isn't even true. Most active funds perform worse than the market does. There was actually a study done that's pretty funny. It came out in 2012 where they were testing to see if a cat could get better results in the stock market by randomly picking stocks than hedge fund managers could. And the cat won. Now, sure, this could definitely be a one-off because it's obviously a pretty random study, but at the same time, there's been a recent study done that said that over a 20-year period, 90% of passive markets do better than active ones. So let's jump into talking about these other options that are more passive and actually give you a better return, and you can keep more of that return for yourself.
Okay, so now this brings us to index funds, which by the way are still a basket of different investments that you can buy all together. But in this case, there isn't that person behind the scenes choosing what's gonna go into that basket. Instead, your basket is passively managed, and its goal isn't to try and beat the market, but it's to try and match it. Now, this is one of those like really funny concepts for people to understand because for a lot of us, our entire lives, we're taught to be better than average, right? We're taught to win. And we see that a lot with investing. A lot of people want to see those big gains. They want to see the winners. They want to see the graph just like shoot up to that corner and just kill it. But here's the thing, like we were saying before, most of the time, and I mean most of the time, when people are trying to beat the market, they end up just doing worse than what they would have done if they had just tried to match it or be average. So now I think the most natural question to ask at this point is that if index funds are passively managed, then who's choosing what goes into these funds? Like who's choosing the stocks? Well, the answer is super simple because it's no one. They're actually designed to match a market index that already exists. And if that sounded like nothing you've ever heard and you didn't understand a single word of what I was saying, I'm gonna explain it in a really simple way. You guys remember how we said that mutual fund performance is trying to beat the market? Well, how do they know if they've beaten the market? The market benchmark that they're using to compare that performance to, that's called an index. Now, an index is a segment of the financial market. So a really popular one that I'm sure you guys have heard of is the S&P 500 index. So this one looks at the performance of the 500 largest companies in the US and how much their stocks have gone up and gone down. This meant that people could now buy a basket of investments that track the S&P 500 index. So for example, had you bought the S&P 500 index fund, you were now guaranteed to make almost the exact same return as the S&P 500 index. So you'd make that return minus any fees. Of course, still much lower than mutual funds, but there are still some fees. So to kind of bring everything together, traditional mutual funds equals actively managed. Whereas index funds, they were introduced as this like passive option that was likely cheaper and gave you a better return. Now, what's interesting, and I think the question that still remains, is how were they able to move so many people over to index funds? If we're following just like regular logic, I feel like a lot of people would have been swayed to stay with their actively managed funds if they were listening to their investment professional who was telling them, you know, why don't you just try and beat the market? Well, the reality of the situation is that a lot of people still haven't switched over. A lot of people are still going to their bank for investment advice, and because the bank wants to make money and they want to push you products, a lot of the time they're trying to sell you those actively managed funds, so that's where they're pushing you. It's funny, I remember reading this story a few years ago about this guy who didn't realize up until he was like near retirement that he'd been paying out hundreds, and I mean hundreds of thousands of dollars in fees just for holding mutual funds, right? Now, he was super pissed about it because they didn't even tell him anything, right? Like they didn't offer him different options. They didn't say, hey, we actually offer our own index funds, which most banks do. Would you rather invest in these? Instead, a lot of the banks just keep you in these index funds and you just keep paying and paying and paying, and you just lose out on so much, right? Now, for us, luckily, for those of us that are tapped in, we know that these other low-cost options exist. Appreciate that. We know that online banks exist, online brokerages. We know that the main thing is that these other options are also just as safe, which is awesome, right? And another thing that I wanted to mention is that in case you didn't understand the power of index funds, Warren Buffett a few years ago made a bet against active fund managers. He basically wagered $1 million saying that the market would 100% beat them. And guess what? He won.
So where do ETFs fit into this picture? ETFs are exchange-traded funds. Now, they're still a basket of investments, just like the other funds are, but the difference here is that they can be traded just like stocks can. Now, this is where the name comes into it. The reason it's called exchange-traded funds is because they're funds that can be traded, just like stocks can, on the stock exchange. Now, there's something that we left out when we were covering the mutual fund and the index fund before, and that's that they can only be traded one time per day. Now, this is usually totally fine as long as you're a long-term investor. The whole idea there and the philosophy is that you're investing consistently over time and you're holding for the long term. So the exact time of day when you actually buy that investment doesn't matter very much. But what's nice about buying ETFs is that if you're a more average investor who's not a professional, you have more accessibility and more control over your investments this way. Now, ETFs can also be either actively or passively managed, which is obviously an important thing for you to know here. So ETFs can also be active or passive. Now, earlier we were mentioning the ARK Innovation ETF. This is a super popular one. It's an actively managed ETF that's run by Cathie Wood. Now, we're personally still more of a fan of passively managed ETFs that run more like an index fund because of the exact same reason we walked through before when we were talking about mutual funds, and that's the fact that passively managed funds tend to perform better in the long term. So the last question is, should you be investing in an index fund or an ETF? Now, it depends on the exact fund you want to be buying, what you want to be in it, what index you want to be tracking. But if you do go the route of buying an ETF, then like I said before, we recommend looking at and considering passive options and investing for the long term versus feeling like you need to track exactly the time of day that you should be specifically buying or selling and could get sucked into making an impulse decision. Now, right now at the time of filming this video, both Dennis and I are investing in ETFs. So he invests specifically in XEQT. That's an investment that has US equities in it. It's an all equities portfolio with US equities and different global markets. And I'm investing with a robo-advisor, also all in different ETFs that cover the Canadian, US, and global markets.
Okay, so like what Steph was saying, when you're choosing what to invest in, we highly recommend you look into index funds and ETFs, but try and stay away from those traditional mutual funds because of the whole actively managed piece. And yeah, I think a couple of the things to consider when you're actually deciding which ETFs and index funds to buy would be the fees, which platforms they're available on, and whether you're able to reinvest automatically. So those things are kind of key. Now, overall, the key piece that we want you guys to take away here is that you can invest passively and still get those long-term returns, or great returns, I should say, without actually having to be an expert. I think that's one of the misconceptions that a lot of people have. You don't have to be an expert. You can invest for the long term and still get those great returns. Anyways, that's it for this video, guys. Make sure you like down below. Make sure you subscribe right there in the corner. And as usual, if you haven't seen any of our previous videos, make sure you check them out next door. We will be back. You guys know the vibes. Let's go.